What's driving Bitcoin adoption in 2025? A new report is out and is tackling this question with 50 pages of facts, figures, and a healthy dose of hopium. Today we've handpicked the highlights and sorted the sensible from the sensational. We've got the answers to questions that matter the most, like how early am I? How bullish is too bullish? And is minor centralization going to be the death of us all? My name is Nick. Stay tuned. Today's bullish Bitcoin report is exactly the kind of a bedtime reading that we here at the Coin Bureau enjoy. However, as a collection of research, it's worth noting that the report was authored and published by River Financial, a Bitcoin financial services company. Naturally, it's not in their interest to publish anything less than the most bullish possible literature about Bitcoin. But, on the other hand, you can be biased and correct at the same time. So, has River hit the bullseye with this report, or is it just another case of bulls getting carried away? Let's investigate. I'll begin with the juiciest and most eyebrow-raising part of the report, which River saved right for the end. According to the report's authors, Bitcoin's adoption in 2025 is at just 3% of the full potential. 3%. Bros, I'm pretty sure that means we're 97% early. The graph on the right here shows us that 3% of potential adoption places us on par with where the internet was in 1990, where social media was in 2005, and where online banking was in 1996. Excellent. This is the kind of big picture that we need when the market is giving us a hard time. But hang on a minute. Where did River get this number from? The authors explain that they arrived at 3% of the potential adoption based on a combination of three metrics: global ownership, institutional underallocation, and the total addressable market. It's not clear how these metrics are weighted, but let's check each of them out. River estimates Bitcoin ownership by individuals to be less than 4% worldwide. And this is based on a combination of global crypto ownership and Bitcoin ownership data from AAA, Crypto.com, and the Nakamoto project. Ownership is by far the highest in the United States, where River estimates it to be 14%. Outside of North America, Bitcoin adoption ranges between 1.6 to 6.6% from continent to continent. The question is, how many remaining 90+% of people worldwide are likely to become Bitcoin owners? And the answer depends on many factors, including the use case that will define Bitcoin for the rest of this century. If Bitcoin is to become a direct competitor to fiat currencies, whose adoption rate in most stable countries is basically 100%, then the answer could be all of them. However, to date, Bitcoin has seen limited use as a medium of exchange akin to fiat currencies. Instead, Bitcoin's primary use case is an investment asset. Now, some say it's a store of value and a hedge against inflation, akin to gold. But since Bitcoin is by far the best performing asset of all time, we think most buyers go in with a higher expectation than your average gold enjoyer. At any rate, if Bitcoin is an investment asset, we might better ask, what percentage of the population owns investment assets? And we'll take the US as an example. According to Pew Research, around 31% of US households own financial assets. This figure might be a more realistic benchmark for mass adoption of Bitcoin by the US public. And while we're on the topic, it's worth considering the uneven impact that mass adoption will have on Bitcoin's price growth. The US stock market might give us a bit of a clue here. More than half of its estimated total value is owned by 1% of US households. Meanwhile, 50% of US households collectively own less than 1% of the stock market. Now, what could this tell us about the future of Bitcoin adoption? Well, the estimates about global ownership suggest we have a very long way to go until mass adoption is accomplished. But at the same time, if the masses are poor, we might accomplish mass adoption and still not be able to afford our condo on the moon. Food for thought. Anyway, this brings me to the metric included in the River Financial's adoption calculation: institutional underinvestment in Bitcoin in the US. Now, this is where the real money is, and I must say the numbers here are incredible. Underinvestment is definitely the right word. The report shows a breakdown of how $128 trillion of US investment advisor money is allocated based on data from the SEC. On a net basis, this money is 53% in stocks, 17.6% in alternatives, including gold and other commodities, 12.5% in corporate bonds, 10% in US government bonds, 4.7% in cash and cash equivalents, 2.3% in foreign government bonds, and, last but not least, 0.006% in BTC. Well, it looks like we have a lot of catching up to do. Now, if this isn't early, I don't know what is. The report highlights that Bitcoin currently accounts for around 0.2% of global wealth, and that if US investment advisors increased their net exposure to it even by this modest level, it would equate to almost $250 billion of inflows into Bitcoin. Now, dare we imagine a day when this allocation reaches 1 or 2%? Is that too much to ask? It seems like a modest allocation to me, but for the price of Bitcoin, the change would be anything but modest. Just a few more institutional toes dipping in the water could turn into some serious gains for Bitcoin. There is a caveat though. River Financial is working with data from 2023 over here. As we all know, last year was a major turning point for institutional interest in Bitcoin, bookended by the world's biggest asset managers launching spot Bitcoin ETFs last January and the US government being reborn as a crypto advocacy group this January. So we would really like to see how US investment advisors' net exposure to Bitcoin looks like more recently. Something tells us it's rather a bit more than 0.006%. Anyway, I'm not sure how far through the author's adoption equation we are yet, but there is one more metric that they included in their calculation. This is the total addressable market, or TAM, for Bitcoin. In business jargon, TAM refers to the total potential revenue a company could generate if it served every single potential customer in the market. This is necessarily a pie-in-the-sky number that helps businesses assess the overall size and potential of a market, and no doubt comes in handy when pitching to VCs about the size of the opportunity on the table. You can imagine how TAM could be extrapolated to Bitcoin. It's basically a theoretical ceiling on the market cap of Bitcoin. Now, the numbers cited here are just mind-boggling, and there is no explanation offered, so you know we had to check those numbers.
It's the place to be when you're in need of amazing crypto deals and opportunities. It's got savings that you won't believe, like money off those pesky trading fees. It's the Coin Bureau deals page. Sign up bonuses and discounts too. The Coin Bureau deals page. We put these deals together just for you, just for you.
River is here using estimates from an incorrigibly bullish 2023 article written by one Jesse Myers, a chief investment officer at fellow Bitcoin financial services firm OnRamp. Myers' argument is that since Bitcoin is a store of wealth asset and all of the world's wealth is stored in one asset or another, Bitcoin's total addressable market is all of the world's wealth. He offers an admittedly rough estimate of all the world's wealth at around $900 trillion using data from 2021. According to Myers' breakdown by asset class, that year, $330 trillion was in real estate, $300 trillion was in bonds, $120 trillion was in fiat currency, $115 trillion was in equities, $18 trillion was in art, and $16 trillion was in gold. Myers then does acknowledge that 100% of the world's wealth being stored in Bitcoin is not realistic, and ponders how much wealth one can realistically hope to be redistributed from these other asset classes into Bitcoin. And this is usually described as the total obtainable market, but the article still uses total addressable market for this figure too. Anyway, obtainable or addressable, this number is anyone's guess, and Myers doesn't waste time trying to be too precise about it. He answers the question with a table of, quote, reasonable, even conservative estimates that find Bitcoin's total addressable market to be $200 trillion, corresponding to a price of around $10 million per Bitcoin. According to Myers, 30% of the value currently stored in fiat money, 30% of the value currently stored in bonds, 50% of the value in gold, 15% in equities, 15% in real estate, 5% in fine art, and 5% in cars and other collectibles will be reallocated into Bitcoin. Seems a bit like a big ask to me, although I won't be complaining if it happens. I will obviously be sipping a pina colada from the sun deck of my attack ship off the shoulder of Orion. Anyway, Myers' numbers are the final puzzle piece in River Financial's Bitcoin adoption data. We can't tell how this means that Bitcoin adoption is at 3% of its full potential, but perhaps this estimate is just an illustration that is supposed to whisper, think big. And we can't argue with that. 2025 has gotten off to a bit of a rocky start, but if you're in Bitcoin for the long haul, the outlook is very good. You can turn on the news any given day of the week now, and you're likely to hear some bullish crypto noises coming from the White House, something that was completely unthinkable even just a year ago. It's an amazing time to be alive. Yes, we may be overdue a recession, but recessions, they don't last forever. Bitcoin, on the other hand, might, and at least for the foreseeable long-term future, all indicators are pointing up. And one such indicator covered in River Financial's report is developer activity on Bitcoin Core. Now, if you're not familiar, Bitcoin Core is the open source software that runs the Bitcoin blockchain, used by 98% of the nodes on the network. It's a full node, meaning that if you run Bitcoin Core on your computer, you are participating in the network, connecting to other nodes, sharing transactions, and keeping your copy of the blockchain up to date. After Satoshi stepped back from publicly working on Bitcoin in 2010, a global network of volunteer developers picked up where he left off and have been maintaining and refining Bitcoin Core as the primary implementation of Satoshi's original protocol. The Bitcoin Core developer community is tight-knit, but highly active. According to River Financial, just 2 new contributors joined in 2024 for a total of 115. Between them, these volunteers changed 276,000 lines of code across 2,500 commits. Since its launch in 2009, the Bitcoin Core codebase has grown tremendously. It now consists of more than 750,000 lines of code and is on course to break 1 million lines if the current trend continues. Now, this may make you wonder what on earth all of these devs are doing and why so much code is needed. After all, the Bitcoin protocol is a set of rules that have been set in stone since 2009 and cannot be changed without a hard fork. And indeed, nobody is fiddling with those rules. A Bitcoin Core is complete for its primary purpose of a decentralized value transfer, but the software is constantly being refined to improve its scalability, security, and programmability. In addition, a lot of this work is just translating Bitcoin Core into a number of different languages. If we turn to River's breakdown of Bitcoin Core code by category over time, we can see that localization accounts for the lion's share of the code expansion since 2009. Documentation, tests, and dependencies also account for hundreds of thousands of lines of code. A Bitcoin Core's base code has been also steadily expanding since the early 2010s, which sounds a little more exciting. Admittedly, the majority of developer activity consists of incremental tweaks whose details are so technical and dry that they would put most of you to sleep. For example, if you look too closely at the changes made in 2024, you'll be bombarded with jargon like ephemeral anchors, Lamport signatures, and orphan rates. However, every code tweak is in service of a bigger picture, a faster, more efficient blockchain with less congestion and fee volatility, fewer bugs and stuck transactions, a chain that can support smart contracts and resist quantum attacks, and one that is no less decentralized and secure than it is in its current state. Now, you're speaking my language. Moving on, the report's authors turn to the growth of the Bitcoin network as measured by node count and total hash rate. Both show impressive growth, with the number of reachable nodes roughly doubling since 2021. And according to River, their number grew a further 11% in 2024, giving Bitcoin almost 22,000 reachable nodes. Now, you may be wondering, what's the difference between a reachable node and an unreachable node, and how many unreachable nodes there might be? Well, reachable nodes, also known as listening nodes, are nodes that are publicly accessible over the internet. They accept incoming connections from other nodes and actively participate in relaying transactions, blocks, and network data. Unreachable or non-listening nodes also contribute to the network by validating transactions and blocks, but they don't accept incoming connections from other nodes nor relay data to the network. They are hidden from direct external access and therefore not easily counted. Unreachable nodes play an important role in the network because Bitcoin's security model depends on both node types working in tandem. As such, the only reason to exclude them from estimates of network size would be due to the difficulty in counting them. Nobody knows the exact number of unreachable nodes on the network, and River doesn't hazard a guess over here. However, there is significant interest in estimating their number, which is understood to significantly outnumber reachable nodes. A 2023 study led by researchers at Beijing's School of Cyberspace Science and Technology, Beijing Institute of Technology, estimated the total number of reachable and unreachable nodes to be between 45,000 and 50,000. And at the time of making this video, this number is thought to have grown to around 62,000, and that's according to BitNodes, an ongoing project to estimate the relative size of the Bitcoin network. So, depending on which nodes you do or don't include, Bitcoin may be around 3 times larger than what you can see on River's graph. The more you know. Now, if you thought node growth was looking good, just wait until you see Hashrate, which, if you're new here, is a measure of the computational power that is used to secure the Bitcoin blockchain. Quote, Bitcoin is now secured by almost 800 exahash of computational power, meaning every second there are 800 quintillion computations being done to secure the network. Yes, 800 quintillion with 20 zeros. Miner hash rate has grown at an average of around 107% per year since 2016, with an increase of 55% in 2024. You can see hash rate going parabolic on this beautiful graph where a banana formation is now well underway. However, the distribution of Bitcoin's hash power is less impressive. Specifically, its concentration in a small number of mining pool distributions is a weak point for Bitcoin's claim to decentralization. The report pulled numbers from hashrateindex.com showing that in December 2024, more than 60% of the network's hash rate was concentrated in just 3 mining pools. Around 80% is in the top 5 pools and 90% is in the top 10. And this is an improvement over a year prior, but it's still not a great look for the world's largest decentralized computer network. Then again, whether this is a gotcha moment for Bitcoin's decentralization is debatable. Fears around mining pool concentration include dominant pools influencing protocol upgrades, prioritizing certain transactions to maximize profit, or submitting to the demands of regulators. Worse still, if the top 3 pools somehow colluded, their majority control of Bitcoin's hash rate would make it possible to launch a 51% attack. They could even halt transactions between some or all users, or even reverse transactions executed while they were in control, allowing the transacted coins to be double spent. Of course, any such scenario would be devastating. But is Bitcoin mining pool concentration a slippery slope that will take Bitcoin there? Perhaps not, because mining pools are hash rate aggregators used by individual unaffiliated miners who can freely switch pools if the one they're using is up to no good. Bitcoin's design and economic incentives make malicious activity by any miner or miners implausible because it would be against their own economic interests. There is no scenario in which malicious behavior would be more profitable than honest mining in the long term. More likely than malicious behavior per se is submission to pressure from regulators. We already have a case study of this happening in the world's biggest mining pool, Foundry USA, which currently accounts for more than a third of global hash rate. In 2023, Bitcoin mining pool F2 pool was caught mining sanctions-compliant blocks that excluded transactions involving certain blacklisted addresses. This was a concerning precedent, but hardly a systemic censorship risk. Now, most mining pools ignored the US Treasury's demands, and the transactions that were excluded were included in blocks mined by other people. As a result, the transactions merely took 1 or 2 blocks longer to confirm than usual. Not only that, but F2 pool lost a lot of hash rate as independent miners started pointing their hash rate to other pools which were not censoring certain Bitcoin transactions. And this proves that Bitcoin's permissionless design ensures that there is no permanent censorship unless all miners collude, and the chances of that happening are very negligible. Collusion between the top pools is also made unlikely by the fact that global hash rate is split pretty evenly between pools in the US and in China, which control a little over 41% each at the time of making this video. So, mining pool concentration. Not the best optics for Bitcoin decentralization, but not as bad as it looks. Now, River Financial's report lists many more vectors of Bitcoin's growth and maturation than we can cover in one video, so I'll drop a link down below for you to DYOR. But while there is plenty of room for nitpicking numerical estimates, Bitcoin really is only going from strength to strength. So if you're bulliever, a word for non-financial advice, set your time frame to the yearly, kick back and relax with the latest update on the US Crypto Strategic Reserve over here. And if you're not subscribed to the channel yet, you can do it right over here. That's me for today. Thank you very much for watching, and I'll see you again soon.